The S&P 500 hit another all-time high, and the Fed's rate cut is practically a certainty. And now you're asking the question everyone is asking. Is this a rocket ship to your financial goals, or a trap hiding a potential crash? It's easy to get caught up in the headlines. You see the market soaring, and a part of you is screaming, "Jump in! You're missing out." But another part, that small, rational voice, is whispering, "Wait, something feels off." You're right to feel that way. Because while the masses are chasing these headlines, they're missing a fundamental truth about what's really happening in the market. This video isn't about getting rich quick by following the herd. It's about a different kind of investing, one built on resilience, not reaction. I've been through market cycles that have made investors lose their minds. I've seen portfolios vaporize in a panic and others grow steadily, quietly through the chaos. I'm not here to sell you a hot stock. I'm here to share the simple, timeless strategy that lets me sleep at night while everyone else is panicking. By the end of this video, you will have a clear plan to navigate this market. We're going to expose the subtle traps hidden in the headlines, and I'm going to show you a simple, three-fund strategy that's built for peace of mind. And maybe most importantly, I'll tell you the one thing I stopped doing that transformed my entire investing journey. So, let's start with the big one. The S&P 500 is at a record high. The news is full of celebratory headlines, but here's the trap. This is what analysts call a narrow rally. You know, the kind where a rising tide is not lifting all boats. In fact, it's more like a few boats are being launched by a rocket engine, while everyone else is still sitting at the dock. The data is shocking. The S&P 500's incredible performance is being driven almost entirely by just a handful of massive tech companies, mainly those focused on AI. In fact, a full 480 of the 500 companies in the index have been underperforming. Think about that. You might look at your portfolio and see a green number, but you're unknowingly overexposed. You're not diversified across the market like you think you are. You're betting big on a few companies. And this isn't the first time this has happened. In the 1970s, it was the Nifty 50, a group of once unstoppable blue-chip stocks like Polaroid and Xerox. During the dot-com bubble, it was tech giants like Cisco. Those companies were the market leaders, the can't-lose stocks of their time. But a decade later, many of those same companies had been left far behind. Market leadership is not permanent. It shifts and changes. So if this S&P 500 record isn't what it seems, what are we supposed to do? This brings me to what I think is the single most important insight happening right now. You heard the news last week, right? The U.S. August jobs report was a disaster. The economy added a miserable 22,000 jobs, a number so low it practically screams recession. And yet, what did the market do? It went up. It celebrated. This is the paradox of our current market, the bad news is good news phenomenon. The market didn't go up because the economy's strong. It went up because that weak jobs report was the final piece of evidence the Federal Reserve needed to say, okay, the economy's finally cooling. We can cut interest rates. This is not some high-level economic theory. This is a profound shift that will directly affect your life and your portfolio. The sentiment out there is a wild mix. Some are celebrating, but smart money is asking if this weak jobs data is the first sign of a coming recession. The Fed, however, has made its stance almost a certainty. The old higher for longer narrative is dead, replaced with a real possibility of an aggressive half-point cut as early as their next meeting. A Fed rate cut will reduce the interest you earn on your high-yield savings account. It'll likely send bond prices soaring, and most importantly, it could make mortgages and other loans cheaper. So while everyone is celebrating an all-time high that isn't what it seems, you can be positioning yourself for a future of lower rates. But that begs the question, how do you build a portfolio that can handle this? This is where we stop playing the market's high-stakes game and start playing our own. The secret to building wealth isn't about perfectly timing a Fed rate cut or chasing the next AI stock. It's about a patient, consistent approach that has historically crushed the returns of those who try to outsmart the market. Forget the complex, expensive, and stressful portfolios. Let's talk about the calmest portfolio I've ever seen, a simple, powerful three-fund portfolio. Now you're probably thinking, show me the numbers. Let's run a backtest and compare the S&P 500 against a classic, diversified, lazy portfolio. A simple mix of U.S. stocks, international stocks, and bonds. Here's what the data shows. From 2012 to 2025, the S&P 500 delivered a strong annualized return of 14.7%. Over that same period, the diversified portfolio delivered a return of about 9.8%. Now, a lot of people will tell you that a 5% difference in returns is a huge deal, and it can be. But that return gap is the price of admission for something priceless: peace of mind and the ability to not panic sell when the market crashes. Let's look at two key metrics. First, volatility, which we measure with something called standard deviation. The S&P 500 had a volatility of around 14%. The diversified portfolio, just 11.5%. That's a huge difference. What this means is that while the S&P 500 gave you higher highs, it also gave you much more stomach-churning drops. The simple portfolio delivered a more stable, smoother ride to your destination. And this becomes most clear when we look at drawdown, which is the biggest peak-to-trough drop your portfolio would have experienced. During the lost decade of the early 2000s, an all-stock S&P 500 portfolio suffered a brutal drawdown of nearly 54%. Over the same period, a balanced portfolio saw a drawdown of only 24.7%, less than half the pain. A portfolio designed for calm and consistency will get you a very similar result over the long term, with a fraction of the emotional stress. This portfolio isn't designed to be flashy, it's designed to be a fortress. This elegant simplicity works because it's built on two core principles: diversification and low cost. The reason this works is that not all assets move in lockstep. When US stocks are down, sometimes international stocks or bonds are holding steady or even going up. It's like having a team where not everyone is a star quarterback. You have defensive players who protect your gains and ensure you don't lose the game in a single play. By owning thousands of companies, you're not betting on a few winners, you're betting on the global economy. And by using low-cost index funds, you're not paying a hefty fee for someone to try and fail at beating the market. You're just capturing the long-term upward trend of capitalism, one consistent dollar at a time. This is the strategy that gives you the peace of mind to focus on your life, not your portfolio. Now, if you're like me, you're looking at that backtest and thinking, okay, that's smart, that's safe, but what about the incredible gains we've seen from those tech stocks? What about the high-flying, high-growth names? You're not wrong to ask that. For those of you with an iron stomach and a long time horizon, there is another path. It's a high-risk, high-reward strategy that flies in the face of diversification. It's an approach built on a concentrated bet on the engine that's been driving the S&P 500's recent performance: a handful of massive tech companies, often called the Magnificent Seven. Let's run the backtest for this strategy. From the end of 2015 to 2024, the S&P 500 delivered an overall return of 178.3%. That's a life-changing number. But a concentrated portfolio of the Magnificent Seven stocks, they delivered a staggering 697.6% combined return over that same time frame. That's a difference of more than $500,000 for every 100,000 invested. This is what makes the market so tempting. But before you sell your diversified funds and go all in, let's talk about what those numbers don't tell you. The ride was anything but smooth. We all saw what happened recently with Nvidia, the poster child for this AI boom, when it suffered a significant single-day loss on news of a competitor. In 2022, when the S&P 500 lost about 20% of its value, that concentrated portfolio fell by a gut-wrenching 41.3%. That's the difference between a tough year and a financial nightmare. Market leadership can also change dramatically. Of the top 25 stocks in the S&P 500 just 5 years ago, less than half outperformed the index. This isn't a one-way street to riches. This is a high-stakes bet where the winners change and the losses can be brutal. So, you have a choice. You can chase that massive upside and accept the risk of catastrophic stomach-churning drawdowns, or you can build a diversified fortress designed to give you a long, peaceful road to wealth. This brings me to my most important point, the one thing that truly transformed my investing journey. It wasn't a stock pick. It wasn't a secret fund. It was what I stopped doing. I stopped checking my portfolio daily. I know, it sounds crazy. We're conditioned to constantly monitor our investments. The all-time highs and the rate cut headlines make it feel like you have to be ready to act at a moment's notice. But here's the thing, that daily checking, that obsessive monitoring, it's not a form of control. It's a form of anxiety. The moment I chose to stop checking my portfolio every single day, I sold the one thing that was holding me back, my own fear. I started investing like a tree. It takes its time. It builds strong, slow roots. It doesn't panic when the wind blows or the weather changes. It just keeps growing. So let's bring it all back home. The S&P 500's new all-time high is not a sign of a universally strong market. It's a narrow rally with a hidden concentration risk. The Fed's rate cut is coming, but it's a direct result of bad news, which means you need to reevaluate your cash holdings and bond strategy. And the solution to all of this isn't to be a market guru. It's to be a smart, patient investor with a simple, diversified portfolio. The most stressful part of investing isn't the market, it's the noise. Your greatest asset isn't a stock, it's your patience. Now, if you're feeling that calm wash over you, and you're thinking about a portfolio that's built for the long haul, you might be curious about one of the most powerful and often misunderstood assets out there. I'm talking about gold. It's a classic safe haven, and it's also hitting new all-time highs, but for some contradictory reasons. Is it a hedge, or is it hype? It's a question that has a lot more nuance than the headlines suggest, and it's something every smart investor needs to understand. To dive deeper into that and learn what role gold can play in your journey to financial freedom, you'll want to watch the previous video I made about gold. Thanks for watching.